The Intelligent Investor. By Benjamin Graham, book summary and 10 important lessons. The Intelligent Investor explains value investing, which is focused on generating steady, long-term profits by ignoring the current market. The Intelligent Investor explains value investing, which is focused on generating steady, long-term profits by ignoring the current market. Graham focuses on investments, based on research, rather than speculations, based on predictions. The Intelligent Investor provides guidance on how to get involved in value investing and how you can prevent loss in market. Many people buy stocks when they've already risen above their peak price and sell them when they've fallen below their best prices. This makes it hard to make money, as transaction fees, taxes, and advisor fees cut into profits. To avoid buying a stock when it's too expensive to offer a good long-term return on investment, investors to define the P/E ratio that works. In order to make as many purchases at optimal prices, investors should devote a small money each month so that they can invest right time. Strategies for investment include finding well-managed funds, getting advice from a fund manager, reading corporate financial statements, seeking stocks that pay consistent dividends and have valuable assets, limiting risk by setting prices low enough to guarantee results. Investors should not fall for the high-portake recommendations without doing independent research. 10 key lessons from the book. Number 1, Process. Investors need a sound intellectual framework for making decisions and also the ability to prevent emotions from corroding that framework. This is actually an observation from Buffett's preface to the 4th edition of The Intelligent Investor. Not to mention something we focus heavily on, here on the value perspective. It signals the importance, above all things, of process. Number 2, Market behavior. The more irrational the market's behavior, the greater the opportunity for the disciplined investor. Number 3, Value and price. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. Number 4, Margin of safety. No matter how careful you are or how disciplined your process, the one risk no investor can ever eliminate is the risk of being wrong. No matter how exciting it may appear to be, can you minimize your chances of making a mistake? Number 5, Your worst enemy. As an investor, your principal problem, one might even say, your worst enemy, is likely to be you yourself. Number 6, Future projections. Mathematical valuations that are dependent on anticipating the future, and less tied to a figure demonstrated by past performance, are more vulnerable to possible miscalculation and serious error. Unfortunately, a significant part of the value of a high multiplier stock is derived from future projections, which, except, perhaps, in the growth rate itself, differ markedly from past performance. Number 7, Bargain issues. Can one really make money in bargain issues without taking a serious risk? Answering his own question, Graham writes, yes indeed, if you can find enough of them to make a diversified group. If you don't lose patience if they fail to advance soon after you buy them. Sometimes the patience needed may appear quite considerable. Number 8, Contrarian thinking. The intelligent investor understands a stock becomes more risky, not less, as its price rises, and less risky, not more, as its price falls. By the same token, since it makes stocks more costly to buy, you should dread a bull market. Conversely, and so long as you keep enough cash to hand to meet your spending needs, you should welcome a bear market to buy good stocks. Number 9, Look beyond yield. Stocks do well or poorly in the future because the businesses behind them do well or poorly, and for no other reason. The company's underlying business must be solid and its share price must be reasonable. Number 10. Sources of undervaluation. There are two principal reasons why the wider market will undervalue a stock: currently disappointing results. As such, Graham writes, an investor should require an indication of at least reasonable stability of earnings over the past decade or more. Sufficient size and financial strength to meet possible setbacks in the future. This form a significant part of our own investment process. This was the tip of the iceberg. To dive into the details and support the author, order the book or get the audiobook for free.